Hello, and welcome to our third quarter strategy review for 2018, which is 5 years. We're actually into our 6th year now. We met here on Wednesday, the 27th, against a backdrop of border problems, trade problems, and even some rearrangement on the Supreme Court. But we tried to keep our eye on the ball because we are managing money, not talking politics, although I've got to admit it's tempting. To that end, we did have a special guest, Dean Amonson, who manages a $500 million bond portfolio, joined us on the phone, and his involvement was most interesting and required because bonds became a very large topic of our meeting, and we'll get into that in a minute. In the meantime, I would like to introduce the other people that were here. To my right, Len Skeena, CEO and Vice President of the firm. To my left, Bob Toomey, Vice President and Director of Research. Also, our paraplanner, Nat Bowie, was here and contributed, especially, I think, in the international area. Just going to take a quick moment and explain because people wonder, what is a paraplanner? And what Nat is doing for us is helping all of us prepare and present plans. In the meantime, she's also taking the CFP course, Certified Financial Planner, which will definitely have her become a full-fledged member of the planning of the firm. So if you haven't met her yet, she's a very nice young lady, and we're very happy to have her on board. One of these days, we'll even convince her she should be on camera. But in the meantime, to my right, again, Len, I'm going to turn it over to you to start the very important section of bonds.
Thank you, Stan. As Stan indicated, bonds were a significant part of the discussion in our meeting, and with good reason. The Fed has been very transparent about wanting to raise interest rates for a while, and they've been raising short-term rates on a reasonable rate for the last several months, and actually going back well over a year now. But what happens is that the Fed can only affect short-term rates. Intermediate and long-term rates are affected by the market. And long-term rates tend to be much more dependent on the inflation concerns of investors. And there isn't really much concern on the part of investors right now for inflation. So long-term rates aren't going up very much, while the short-term rates are continuing to go up. In addition, there is a great demand for U.S. Treasuries and interest rates here in the United States because they are higher than they are in other parts of the world. And as those demand continues to rise here, it's going to continue to keep interest rates lower. That is causing a concern where the Fed is going to raise interest rates on the short term, but the intermediate and long term will stay low enough that eventually the Fed may push short-term rates higher than those in the intermediate or the long term. And what you'll have at that point is something called an inverted yield curve. Now, nothing seems to have the predictive consistency that an inverted yield curve does. Every single time there has been an inverted yield curve, it has led to a recession. The Fed knows this. They're not going to fool around with that. And we don't think that the Fed is going to end up pushing these rates high enough to cause that, but they're going to be walking a tightrope and they're going to be constrained in what they do. We're trying to protect you by going to as much in the way of floating rate investments as we can, as well as pushing our duration to the shorter end, which is less volatile. And to that end, we've made changes in the portfolio to accommodate that. For now, I'd like to turn it over to Bob to talk about equities.
Great. Thanks so much, Len. Well, as I'm sure many of you are aware, it's been a very interesting first half for the stock market. But believe it or not, year to date, despite all the volatility, stocks are up just under 3% as measured by the S&P 500. And that does not include dividend yield. But we have seen higher volatility, as we predicted earlier this year, due to the trade war concerns. And I think, as Len mentioned, these concerns over what the Fed is actually doing with respect to their interest rate policies. I would say that we expected this, and I think the market has pretty much acted the way, especially in terms of volatility, has acted the way we expected. That said, the economic underpinnings for the U.S. remain very strong. The U.S. economy is firing on all cylinders. We look at, as you know, employment is strong, consumer spending is strong, capital spending is strong, and sentiment for both business and consumers remains strong. Corporate earnings look to be very strong. In fact, this second quarter, we'll see second quarter earnings will start to be released in July, and we're now looking for something in the range of 25 to a 30% year-over-year increase in corporate earnings. So that is, again, a strong underpinning for the market. Len talked a little bit about the Fed. The Fed has been very transparent in their policy and what they're planning on doing. And I believe that based on their most recent statements, they are not going to take actions that would be extremely disruptive or deleterious to the stock market. One concern I do want to address with respect to equities is, if those of you that may look at the financial news on TV, by the way, we hope you don't, because it's a lot of it is a lot of blather, and you have better things to do in your day than watch the financial media. But there's this concern out there that it's right now things are as good as they can get. Largely, part of that is due to the earnings, the cresting of growth of corporate earnings. We don't buy that argument. We think valuations are still quite reasonable at 7 times forward earnings. We think the U.S. remains the country of choice for investment. We believe the trade war concerns are somewhat overblown, although they do remain a risk. And I think that corporations will continue to show very strong cash flows going forward that will support higher equities in the second half of this year. So we're still on track with full year growth in U.S. stocks in the range of 6 to 8%, and we remain overweight U.S. equities. Now I'd like to turn it over to Stan to talk about REITs.
Thanks, Bob. The REIT portfolio was augmented, as you may recall, with an actual REIT instead of an ETF that emphasized the industrial portion of the REIT markets. We actually continued to move in that direction. We still like the overall dividend return from the REIT portfolio, but the reason we continue to move away from our longtime holding of VNQ, which is the ETF, is that it has a pretty good exposure to the retail through the large shopping malls. The advent of Amazon and other companies that are getting into the direct marketing is continuing to hurt this area. And actually, we definitely paid attention to the fact that Amazon buying a direct mail order pharmacy just knocked down the Walgreens and the other normal pharmacies. So again, you will see more of us moving towards that industrial REIT, trying to get more exposure to the industrial side and reducing the shopping center side. With that, I'd like to turn it back over to Len for the international outlook.
Thank you, Stan. On the international side, there's been a lot of talk and a lot of things going on in the press. We are seeing a lot of threats of trade wars. We are seeing the U.S. threaten to, and in some cases even tearing up, certain trade agreements that we have. And we feel that a lot of that is going to end up being something that makes for big headlines and affects the headlines far more than it affects the underlying economy. We still do see the international arena as being a reasonable place for us to be investing. We are looking, though, at the larger markets, no longer looking at the emerging markets. The emerging markets, we feel, with the slowdown in China as well as just with the overall situation internationally, it's not a place that we feel comfortable being at this time. And so we have decided to pull back on that and emphasize the EFA area that we have been emphasizing for quite some time, which consists of Europe, Australia, and the Far East, but the large developed economies rather than the emerging ones. With that, I'm going to turn it over to Bob to talk about changes in our model.
Great, fantastic. Thanks, Len. So essentially, as I mentioned earlier, with respect to the macro condition of the models itself, we remain overweight U.S. equities for the reasons I discussed earlier. We do remain pretty balanced between value and growth in the United States. We've been favoring value slightly, and we still do that, but it's pretty balanced. We maintained sector investments in healthcare and financials. We continue to like both of those stories. We think the story for financials remains strong as we see rising interest rates, a growing economy, and increased M&A activity in this year and next year. We think that positions the banks well for continued good relative earnings growth. We still like the healthcare story, but interestingly, we decided to remove the investment in the legacy healthcare companies, such as the drug companies like Lilly, Bristol Myers, Pfizer, those types of companies. And we invested that money into a new ETF, the medical device ETF. The ticker symbol for that is IHI. And we believe that we like that area because we think medical devices inherently have somewhat higher growth potential and less risk of price pressures from both generic drugs and legislation that might affect healthcare pricing. We did reduce this quarter our weighting in international equities slightly. Len talked about that a little bit. We eliminated our position in EM just because we think that there are concerns over growth in China, and we still favor the U.S. as an area that we still think is showing better relative growth, at least at this point. So we also remain overweight in the area of natural resources, largely because we think that the prospects for inflation are rising somewhat, and we think that that will cause increased rising pressure for commodities such as industrial metals and oil prices. And our holding in that area, the GUNR, which is the upstream natural resources ETF, gives us very good exposure in both metals and energy. So with that, I'll turn it back to Stan for some closing comments.
Thanks, Bob. At the end of the session, as we normally do, we talk about a trigger. Triggers are sometimes reviewed on these sessions, sometimes not, but this one is fairly important, so we do want to review it with you. We are showing on the screen right now is a chart showing the relationship between the 2-year Treasury note and the 10-year Treasury note. And as that gets to a 0 point, that would create what is called an inverted yield curve. An inverted yield curve, as Len referred to, has actually always created a negative event called recession. Now again, keep in mind that when we talk about a trigger, we don't expect it to happen. That's why we have a trigger, but it does give us the opportunity to make reasonable changes in direction as opposed to doing them on the fly and in the concern of the moments. So in this case, if we do hit that trigger, and again, remember, we're not expecting it, but if we do go to that negative yield curve, it will create an environment where we will actually make a change that we haven't made for many years, actually. And that is go back to Treasury securities as opposed to corporate securities. And that corporate securities, by the way, has created a very, very good environment where our bond portfolios, for the most part, have done better than the indexes, which are Treasury indexes that we compare to. So again, don't get concerned, but keep in mind that we could go to a negative yield curve, and that's what we'll be keeping our eyes on. So with that, I'd like to close the session, refer you, as I often do, to the fact that all of these quarterly videos are on our website. And I was looking at the one 5 years ago, which would be the third quarter of 2013, and found it very interesting because we were talking a lot about bonds at that point and how they affected the stock market, and we may be, again, getting to a change in that. So I refer you all to that, and thank you very much for listening. Please tune in again next quarter.